This video is an Uncovered Japan company research report on Realgate, ticker 5532. Realgate takes aging mid-sized buildings in central Tokyo and turns them into design-led flexible offices, controlling the process from sourcing and design to construction, leasing, and operation. The appeal is a focused niche and fast growth. The question is whether that operating strength can stay ahead of the debt and valuation required to fund it. At the July 2026 research date, Realgate traded at about 28.5 times forward earnings and 5.2 to 6.3 times book value. Return on equity was 18.7% in fiscal 2025, and stock-type sales were 62.5% of revenue. Those figures help explain the growth premium, but the company also carried roughly 4.2 times debt to equity, making capital structure central to the investment case. Realgate focuses on older buildings, typically about 20 to 40 years old, and around 500 tsubo, in Shibuya, Minato, and Meguro. These are often too small for major developers to prioritize. Realgate can source a building, redesign it through its in-house architecture and construction capabilities, lease the finished space, and keep operating it. That full chain lets the company capture design, build, leasing, and ongoing management economics, rather than just one fee. The financial record shows real operating leverage. Revenue rose from 5.84 billion yen in fiscal 2022 to 9.79 billion in fiscal 2025, a compound annual rate of about 18.7%. Operating profit rose from 429 million yen to 1.04 billion, or roughly 34.4% annually. Operating margin widened from 7.3 to 10.7% as the mix shifted toward higher margin property income and renewal rents increased. The company uses 5 revenue models: property management, master leases, in-house design and construction, rent from owned property, and property sales. Their interaction matters more than any one line. A building that Realgate renovates and sells can still provide master lease or management income afterwards. In fiscal 2025, master lease, management, owned rent, and attached design and build activity together made up about 62.5% of sales. The remaining flow revenue is more volatile because it depends on deal timing. The important caution sits below operating profit. In fiscal 2025, operating profit was 1.04 billion yen, but recurring profit was 827 million because interest expense reached 160 million yen. That was up from 66 million the prior year, a 2.4 times increase. The operating business is improving, but as the company borrows to build its owned property portfolio, more of that improvement is claimed by lenders before it reaches shareholders. Realgate's balance sheet roughly doubled in 2 years as it shifted toward owned buildings. At fiscal 2025 year-end, total assets were about 21.3 billion yen, and tangible fixed assets 14.4 billion. Interest-bearing debt was 13.9 billion yen, against net assets of 3.35 billion, leaving an equity ratio of only 15.5%. High return on equity is attractive, but it is inseparable from the leverage producing it. The strategic upside is clear. Management wants to increase annual acquisitions from 8 to 12 buildings, extend the owned property model, and work with Hulic through the History joint venture, which targets around 100 billion yen of investment over 5 years. Realgate's concentration in central Tokyo creates local sourcing and operating efficiency. Yet the same plan increases the need for debt or equity. The growth accelerator and the financial constraint are the same thing. The report's 3-year scenario analysis highlights the asymmetry. The fiscal 2028 bear case values the shares at 1,325 yen, the base case at 3,538 yen, and the bull case at 6,334 yen. At the research date price of 3,595 yen, the market was already close to the base case. Outcomes turn on stock revenue growth, operating margin, funding cost, and the multiple investors are willing to pay. Realgate has been public only since June 2023, but its multiple has already been volatile. Year-end forward PE moved from 31.2 times in fiscal 2023 to 13.6 in fiscal 2024, then 31.3 in fiscal 2025. At roughly 28.5 times, the shares were again near the top of that range. This is not simply a growth story, it is a high beta valuation that can re-rate sharply if execution, rates, or risk appetite disappoint. Relative valuation makes the trade-off sharper. Realgate's roughly 28.5 times forward earnings and 5 to 6 times book are around 2 to 3 times the real estate sector on earnings and 3 to 4 times on book. Its fiscal 2025 return on equity of 18.7% is more than double the sector average near 8%, so some premium is justified. But the valuation requires years of successful compounding and leaves little room for a financing or growth stumble. Realgate has a credible central Tokyo regeneration niche, real in-house execution capability, and meaningful recurring revenue. Its risks are not hidden: leverage, rising interest costs, possible dilution, and a valuation already near the top of its own range. For investors, the monitoring list is straightforward: stock type, revenue growth, operating margin, funding cost, the equity ratio, any new share issuance, and whether the Hulick partnership scales without overstretching the balance sheet. This is research, not a recommendation. For a much deeper look, visit the free deep dives at uncoveredjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security. Always do your own research.